Right, welcome to part one of lecture one for FMGT 3224. Where we are going to cover both chapters 1 and 2. So the first thing we're going to look at from chapter 1, and really we're only covering a small chunk of chapter 1. We're going to talk about the management cycle itself. Now, this is, I think if you were to sit down and think about it, fairly intuitively obvious. You need to plan what it is that you're going to do. You then go and do it. And then you sit there and observe the outcomes and try to decide, did it do what you wanted it to do or not? And so what you want to take away from this diagram here is a business is going to have its overall purpose here on the left, the mission, vision, objectives, and so on. They're going to guide the plans that it makes, and which will drive the implementation and so on. What we've learned, or what you would have learned in first year, talks about, in financial accounting, talks about how to measure these outcomes in terms of financial statements and so on. And so that's where you would get the products that you learned how to create last year, and so they are used by external stakeholders and so on. Management accounting is a little bit different, and what makes it different is that it is decision making primarily for folks. It's information for decision makers primarily for people that are inside the organization. So it focuses on the information used to help plan and then monitor the implementation as it goes. So this would be things like cost and profitability, your budget and how you are performing against your expectations that are in that budget and so on. So that, in a nutshell, is the management cycle. So we touched a little bit on the differences between management accounting and financial accounting. Management accounting is provides information for managers of an organization who are essentially internal. So they will direct and control the operations, as opposed to financial accounting being focused on people who are outside the organization. So a little bit more emphasis or detail on the distinctions between the two. So financial accounting, again, mostly external users, whereas management accounting is internal. The time horizon, financial accounting is backwards looking, right? It looks at how you did last month, last year, last quarter, whatever. Management accounting tries to look toward the future. Financial accounting, emphasis on verifiability. In other words, how accurate is it? And we have that whole structure of GAAP to guide us, not necessarily in terms of accuracy per se, but in terms of a consistent approach to how to do things. Whereas management accounting is a lot of it's the 80% solution, right? It's predictions, it's information that is going to be mostly right, but not 100% right, because you need it now to make that decision. Financial accounting, again, the emphasis on precision. Management accounting, this is no good if it's 100% accurate and 3 weeks out of date kind of thing, which is what financial accounting really is all about. Units of analysis, you can divide up the organization into smaller chunks with management accounting. You can actually do that with financial accounting too, so we won't fuss too much about that little row on the table here. Regulation, we're talking about GAAP here. There is no GAAP for management accounting. It is basically what makes sense for the business to employ in terms of its decision making. Now, management accounting is becoming more and more relevant, and the reason is, there's a few. Globalization making things more competitive out there. Management accounting is information that will give your business an edge. But typically, it costs money to gather that information. And so, historically, only large corporations had well-developed management accounting systems. That's changing as competition is heightening. Businesses are looking anywhere and everywhere for an edge. Yeah, kind of covered that as well. And ethical responsibility, I'm not sure what that has to do with the increasing relevance of management accounting. But anyway, there it is. All right, so that in a nutshell was your quick overview of Chapter 1. The meat of Lecture 1 deals with Chapter 2, which is cost concepts, some definitions, and how we go about classifying costs. So one of the easiest ways to classify a cost has to do or is around its behavior. And we talk about behavior being variable or fixed. And essentially, you have to remember that they're variable or fixed with respect to something. And that something, in this case, is the business activity. Okay, so that's most often production or sales or something like that, but it can relate to something else. So the key here, though, is costs are either variable or fixed or some combination thereof as an activity increases. So if you think of a variable cost, the classic example is a long distance phone bill. Every minute you talk on your cell phone, unless you have one of those talk anywhere plans where you pay $1 million, every minute you talk, your bill goes up, right? So that would be an example of a variable cost, whereas a fixed cost is not one that deals with airtime, but one that is more the standard cost. This would be like a landline for local calls, where it doesn't matter how many local calls you make, you're still paying TELUS $30 a month. Okay. So at the end of the day, it's important to understand this behavior, because what we're going to do is we're going to use those behavioral characteristics down the road to predict future cost. And so knowing how they behave is important for us. So again, to summarize, variable costs, they change when the activity level changes, and fixed costs don't. You can look at the per unit amounts, which sort of behave differently. One of the interesting elements here, if you look at this, fixed cost per unit goes down as activity level goes up. So what this can mean is a lot of companies that are in the manufacturing business, if they have high fixed costs, if they produce a whole pile more output, then their costs per unit go down, right? And they have a selling price per unit. So if the cost per unit goes down, then they end up with a bit of profit. The key, of course, is you got to be able to sell the stuff, right? Just manufacturing it and having it sit in your warehouse is not going to do your company any favors. So let's do a quick little check here. Take some time and see if you can answer this question on your own. Okay, so is the cost of lighting the store going to be variable? Probably not, right? The lights are on or off no matter how many ice cream cones they sell. Same thing with the wages of the store manager. Presumably that dude or dudette is getting paid a fixed amount per hour or per pay period, and so that's not going to change. But the cost of the ice cream, so the input cost, the more ice cream cones you sell, the more ice cream you're going to have to pay for. And same goes for the napkins for the customers. All right. So another way we can classify costs is by the terms direct or indirect. And this has to do with how easily we can trace or attach them to the product that is being produced. They fall into two broad categories. The first is direct costs. So these are costs that can be easily and conveniently traced to unit of production. And the sort of standard examples there would be what we'll call direct material or direct labor. And the by contrast, the other category here is something that we'll call indirect costs. And these are where it's not economically feasible to trace the cost to the unit of production, or what we'll call the cost object. So imagine that you are, we're talking about making wooden chairs, right? So let's say you get some flat boards and some round dowels for the legs. You can pretty much say, look, that dowel over there went into that particular chair. So it's easy to trace the cost. If the dowels are, $2 each, you can say $2 worth of dowels times 4 for 4 legs went into that particular chair. Same with the guy who, smeared glue on the dowel and stuck it into the hole on the board to glue the dowel into place, right? His labor, he worked on that chair for 5 minutes. So you can calculate his hourly rate of labor times the amount of time he spent working on that one chair. But what about the cost to rent the factory, where you're making tables and chairs and, I don't know, bicycles and God knows what else? It's not really economical to take those, the cost of rent and try to figure out how much belongs to that one chair directly. And so the way that we will, deal with those costs when we're trying to figure out how much to attach to an item is we will allocate them, and that means that we'll go through a process of sort of mathematically applying the costs to the item as opposed to tracing and following it. Big long explanation, but that will become clear in the end, and this will become a pretty relevant area of cost classification for us down the road. So some other examples here. If we're talking about a flight, so an airplane flight from, I don't know, Vancouver to Montreal, the wages of the pilot, the flight attendants, the fuel, and so on, those are all direct costs. You can easily attach them to that particular plane. The baggage handlers, ticketing staff, that gets harder, right? Because they handle stuff for a lot of different flights, and who's to say exactly how much of that baggage handler's wage belongs with that particular flight, and so on. So that gives you an indication of the distinction between direct and indirect costs, and why we will treat them differently in terms of how we account for them down the road. Another sort of definitional thing for us to look at is the distinction between merchandisers and manufacturers. So merchandisers basically buy somebody else's products for a low price and turn around and sell them for a higher price. By contrast, a manufacturer they'll buy or even make, if it's if they're harvesting lumber or something, the raw materials, and then they will turn around and work on those to create finished goods, which they will then sell, potentially to a merchandiser, right, or even to another manufacturer. So the difference here is merchandisers buy and sell the product. They don't actually manufacture or add much value to the product itself. They may repackage it, what have you, but it's not the same as a manufacturer where they are actually building or creating the particular project in question. And so when we look at the product itself, we've got direct materials, steel, rubber, plastic, that sort of thing. Direct labor, the big guy on the assembly line with his riveting thing and his blowtorch and doing whatever they do when they manufacture cars. And then those manufacturing overhead, that indirect cost, the rent and the cost of electricity in the factory and some of those things, it's much harder to attach to that one individual vehicle. And we will continue with this in part 2 of the lesson.